Good day, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon free live webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonik to the stage. We'll be talking about screening for credit put spreads. How you doing, D?
Good morning, Will. How are you?
Let me share your screen. There we go. And here comes the Market Chameleon landing page, and we're ready to go.
Good morning, everyone. Let's first navigate to our credit put spread screener. So we're going to use the menu up top, hover over screeners. We're going to come over here and we're going to look at bull put spreads for our example. So we're going to click on that. And this takes us to our bull put spread screener where we have the filters above and the data table elements below. And in today's example, what we're going to do is try to narrow down the potential candidates based on potential payoffs for these different spreads at expiration. So the idea here is, as you could see, we have all these different combinations of put spreads. So here we're right now sorted by highest market cap stocks. So you could see in NVIDIA. If we come over here, we see that there are different combinations of strikes. So you're selling one strike in a put, buying a put with a lower strike in the same expiration. So you could see there are different combinations of strikes that you could do. And we could expand this. We're going to come up here and let's just expand these instead of defaulting into the next monthly expiration. We're going to look at, let's look at any option expiration expiring within the next 30 days. So if it's expiring in a week, in 2 weeks, 3 weeks, it'll all appear in this spread screener. So you could see we have 133,000 different combinations because right now we're looking at NVIDIA, but if we keep tabbing, it'll go to the next stocks. So how do we start narrowing them down? And we have all these different filters to help us do that. And let's use, actually we're going to use a combination today of filters. And I'm going to go over here for first, we're going to go to our volume analysis tab. And the volume analysis tab looks for spreads. So it looks at each of these spreads. And if we detected a trade in that spread. So, when we look at multi-leg orders, we detect if these were a particular spread. And if we did detect that here's a put spread, like for example, here's one in NVIDIA, the March 27th, 180, 185 put spread. If we go over here, traded 2 times today for a total of 6 contracts. So this is the average price and average bid and ask at the time with the stop price over here. And traded at 12, 13, 22 the last time. So what if we wanted to look first for spreads that had some trading activity? So sometimes these spreads don't trade at all. And sometimes, they'll have larger volumes, like over here. So to narrow this down, we could use our filters above. We'll go to up here and we have this trade data, multi-leg traded volume. And let's say we want to look for spreads that had at least 100 contracts in total traded, or maybe let's do 500, so at least 500. So what we want to do is narrow down these from 133,000 to a lower amount of candidates to analyze. So we're going to use this, and we're going to say at least 500 or more contracts. So I'm going to click on that. And now this is going to reload our table. And you can see now we have 199 different combinations. So now you see in NVIDIA, there are a few different types of spreads that traded over 500. Then we got Google, Microsoft, and these are all sorted by highest market cap stock. Well, we still have a lot of, 199. But we did narrow down to traded spreads. So how else can we keep narrowing them down? And when we look at spreads and the different combinations, well, these different strikes and the prices that they're available right now have a different payout and different risk at expiration, right? So now we have these combinations of spreads. The strikes are a different distance away. The prices are different. So how do we kind of narrow this down more? And we could then jump to our strategy payoffs tab. I'm going to come over here, and we're looking at the same spreads, but now we're looking at it from a different perspective. And before I go to the strategy payoff, let me just show you the summary. So over here in this, for example, in NVIDIA, the March 20th, 155, 160 put spread. Right now, the market price is 53 cents. So there's a bid and an offer on this put spread. And if we analyze it from the best price we could sell it, because a credit put spread, you're selling it on a bid. So we're looking at the bid price, and we compare that, that would be our reward, potential reward. And we know that our potential loss would be the difference if this entire spread was worth, these are the difference between these strikes are $5. So if the stock drops below 155 at expiration, the spread is worth $5. Well, if we received 53 cents for it, if we have to buy back for $5, we lose $4.47. So that's our risk. So our risk is $4.47 to potentially make 53 cents, right? So our potential is 11 or almost 12% reward based on the amount we have at risk. So now we have these, and let's come back to the strategy payoff. And the stock could go, it could be anywhere at expiration. But if we give it certain points, we could kind of say, okay, if it reaches this point or this point, what is this? What is the payoff? So one is, well, what if the stock goes up, right? So we could say, well, if the stock is up 1 standard deviation based on the volatility, well, what is our potential reward? So you could see here in this particular case in NVIDIA, this spread, the reward is almost 12%. This one is 6.4. This one is 23.8. You could also look at the downside. Well, what if we're down 1 standard deviation? Well, in this example, in NVIDIA, you're still up 11.9% or 12%. So these strikes are further away than 1 standard deviation. Basically, you could see here NVIDIA is 180. The strikes are 155, 160. So whatever that 1 standard deviation is, based on the volatility, it could be $10, $12. It'll still be above 160. So your reward is still 11.9, 6.4. Here it's lower. Here you're losing 52.4%. So you're down 1 standard deviation, you're gaining 52.4%, up 1 standard deviation, you gain 23.8. So you could see that this stock, the price is closer to the strikes. Then we have these other metrics in between. And these are looking at historical stock price instead of like a standard deviation based on volatility. Well, if we use other metrics, like, if there's, let's say, whatever it is, 10 days to go, trading days to go from now till expiration. If we look at historically, what is the average move over 10 days? Let's say it's 2%, minus 2%, plus 2%, whatever it is. We'll say if it equals that, what is the potential payoff? So you can see here, these are the potential payoffs. 55%, 11%. We could also do it if we divide it up in other points. What if the stock is flat? What if it just sits at the same spot? So you could see here that the potential payoff is still 12%, because if NVIDIA is at $180 at expiration, well, the 155 put and 160 put will be expire worthless because they're out of the money. So you keep that credit, right, that you received. And based on what you had at risk, that will be 12% gain. So if the stock is flat, we could screen by that. So let's try that. If we go up here and we click on payoffs at expiration, I think it is in here. Let me see. Or payoffs at expiration. I guess let me see. I guess I don't have the if stock is flat. Okay, so we have the other ones. I think I have it. I don't see where it is, though. I'm pretty sure I have this. All right. Well, let's stay with this one, the payoffs at expiration. Let's say we do if the average up move. Okay, so we have if this average up move. So what this does is it looks at what if we took the historical data and looked at only the moves it was up. Okay, so what was the average up, right? Let's say we divided our data historically and said over a 10-day period, we're going to take away all the down moves and just looked at the up moves. And if we use that average move, right, what would be the payoff? So let's say we were looking for a payoff of 15%. So click on that, and then it will return us if the average move is if the stock performs whatever it did historically, when it was up, on average, what would the payoff of this spread be? So you could see here, these now narrowed it down to 125, where the payoffs here will be at least 23%, 92%, 58%. Okay. What if we wanted to look at another example and say, well, what if the stock, I'm going to leave this, that I need at least 15% gain. If the stock just performs if it's up and it performs its average up move. But if it's down one standard deviation, can you find me any spreads that I still don't lose? So even if we risk a one standard deviation move, are there anything there that that still potentially we could make? So we're going to put any positive. So what happens here is we're trying to pick so now we're down to 9. So what we did was look for spreads that if we're up, right, if we are up and the stock is up, whatever it is on the average, historically, we need at least a 15% return. So these are the spread combinations. So you could see here, in Google, you have the March 20th, 280, 285 put. In SPY, you have a few of them. In March 4th, 669, 674 put, and so on. You have one in QQQ. But at the same time, we said, well, if we're down one standard deviation, which is over here, we still want to at least break even or make. So in this case, you could see we're still up 17% in Google and SPY. So if SPY is down one standard deviation today, so this is expiring today, this spread's still making 3.1%. If SPY, these are all today. This one's April 2nd. If we're down, for example, in SPY from 679, one standard deviation for this time period, this spread would still yield 15.2% return. So what we're doing is using, in this example, we use 3 filters. We first narrowed it down to spreads that have volume. So these are spreads that already traded on the day. Over here, here's 10,000 contracts. Then we narrowed it down further, but by potential payoffs at expiration based on different potential points. Okay, so we picked some points, and that's and based on that, we narrowed down our candidates for further research. Okay, so I'm going to stop right there, I think. Oh, here we go. Now I see what I wanted to show you guys. Before we go, let me go back to Annie here. And I'm going to keep it on this. So here, when we said if the stock is flat, we do have a filter here, show best, where show me the best return if the stock is flat. So if we just wanted to see in each category, what is the best yield if the stock is flat, given, these other filters, we'll go over here, best return, stock's flat, click on that. And then it's going to reload. So here in NVIDIA and Google, so you can see if return if the stock is flat. So if NVIDIA is at the same spot at expiration, then this particular spread will yield 58%. In Google, this will yield 17%. In Microsoft, 28%. So that's another way to screen out opportunities if stock is flat. And, I do have this filter in there where there had to be at least 500 or more contracts traded in that spread. All right, well, I'm going to now throw it back to you.
Hey, great job as always, Dee. Thanks for bringing these webinars to the Chameleon community. Much appreciated, my friend. You have a great day.
Thanks, everyone, for joining. Stay safe and have a great trading day.
All right, we'll see you tomorrow, Dee. Same time. Have a great day. Bye-bye. Hey, everyone. Thanks for joining another Market Chameleon webinar. Remember, thumbs up. Follow us on all the social platforms. Everyone have a safe trading day, and we will see you tomorrow.